Let's talk about the economic backdrop because jobless claims out this morning. 205,000 Americans filing for first-time unemployment benefits last week. Now, that is less than expected and also the latest sign that the economy is holding up much better than forecasters had initially expected. Real GDP is on track to grow 2.5%, unemployment remaining below 4%, and inflationary pressures are abating. But will this momentum continue into 2024? And what will the U.S. economy look like? We want to bring in Mark Zandi. He's Moody's Analytics chief economist. Mark, you're the perfect person to talk to about this. Obviously, you have been out with troves of data over the recent weeks, recent months here, just tracking the performance that we have seen. The economy has held up much better than most forecasters had anticipated. What does that then tell us about next year?
Well, I think it should be a reasonably good year. I think as long as American consumers hang tough and continue to do their part, continue to spend, I think the American economy will continue to move forward. And, all the factors that you consider when considering consumer spending look pretty good. Lots of jobs. You mentioned the 4%. Sub 4% unemployment rate. Real wage growth is now stronger than the rate of inflation because of the throttling back of inflation. Still a fair amount of excess saving among high-income, high-middle-income households. Stock market pretty close to a record high. The housing values close to a record high. Most households have done a pretty good job locking in the previously low rates. Low-income Americans, they're struggling, but middle and high-income Americans are doing quite well. I think they'll continue to spend, and the economy should be fine.
I mean, that's a lot of pressure on me, you, on Shauna, on everybody that's watching here today, Mark, just to continue spending, continue to showcase resiliency.
Oh, it's so tough. That's such a tough thing to do, keep spending.
Yeah, exactly. I mean, Mark, when you think about if there are cracks in the resiliency of the consumer that are starting to show right now, where would they be? Where would you point to?
Yeah, I mentioned low-income households. They are under a significant amount of pressure. They got nailed by the high inflation. Even though inflation is moderating, they're still, we're all still paying a lot more for everything compared to 3 years ago. Food, housing, gasoline prices. So that's hurt. And of course, low-income households have turned to credit cards, consumer finance loans, and taken on debt. And now with these high interest rates, have to pay more in interest expense. So that's where, if there's an Achilles heel in the consumer, it's there. That's where I think the pressure will be. But here, just a statistic: folks in the top third of the income distribution, they account for 2/3 of the spending. So the American economy can't flourish unless we're all participating and everyone's able to enjoy the fruits of the better economy. But it can continue to move forward if high-income, high-middle-income households continue to spend.
Mark, what we've continued to hear from the FOMC and its members is that wages aren't the primary driver still of inflation. However, what we've seen is some landmark deals come across as a result of labor negotiations, which also helps as a somewhat rising tide for certain industries where those negotiations have taken place, as employers have more pressure to raise wages to retain employees. So, all that considered, do you believe that we're going to see, especially considering the resiliency that we've seen in household balance sheets to this point, do you believe that inflation could once again kind of rear its head sometime into next year if we do kind of see some of these sustained moves in rising wages?
Yeah, I'm possibly, yeah, but I think that's a kind of a low risk kind of scenario. I mean, wage growth is strong, but it is moderating. If you look at the plethora of the wage data, it says wage growth is about 4%. I'd say that's pretty close to where the Fed would want to see it to be consistent with 2% inflation. That would be, you need to have 2% productivity growth to make all that arithmetic work and to ensure that inflation remains near 2. And that feels like where we should be, feels like where we're going to stay. Yeah, the labor market is tight, but it's not overly tight. It's actually eased up a bit here. Quit rates are down, which is key to wage growth. Hiring rates are down. Businesses have cut back hours. So, yeah, it's a possible scenario. Things could get overheated. Wage growth could accelerate. Inflation become an issue again. But again, I think that's not the most likely scenario for next year.
Mark, when it comes to the housing market, you mentioned before housing values close to record highs, higher mortgage rates, obviously really being part of the problem when it comes to the fact that homeowners are staying in their homes. Home affordability is a real issue. Where do you see mortgage rates settling when you take a look at about a year from now, the end of 2024? What does that level look like?
Yeah, I think somewhere between 5.5% and 6%. That would be, and just for context, the current 30-year fixed rate loan is going for, I think, 6.6%. It was as high as 8% if you go back, I think at this point a couple months ago. But as you say, a year from now, looking, past the near term, I think we settle in. So if I were thinking about buying a home, I'm doing the arithmetic in terms of what monthly payment I expect to pay, I would pencil in a 5.5, 6% mortgage rate. Say let's 5.75. That would be consistent with a 4% 10-year treasury yield, and that spread between mortgage rates and the 10-year yield is somewhere between 1.5, 1.75 percentage points. So 5.75%. By the way, that might not resonate with lots of people given how low rates were before the most recent period. I mean, we were down into the twos not long ago, so that will be hard for people to digest. But I think that's ultimately what they have to adjust to.
Mark, if we do see that 5.5% to 6% mortgage rate range by the end of next year, what's that going to do to inventory and ultimately to prices? Are we going to see more pressure then on prices?
I expect some price weakness. Yeah, I think ultimately, even if you get mortgage rates back down below 6%, it's still at these house prices. Housing is still not affordable for most potential first-time home buyers. So I think we will need to see some price declines. And I think what will happen is those households you mentioned that are kind of in their home with a 3.5% mortgage rates kind of locked in. Over time, life happens, right? Divorce, death, children, job change. People need to move, and when they start needing to move to sell that home, they're going to have to start giving a bit on price. So if you told me, a year, 2, 3 down the road, house prices nationwide are 5% below where they are today, I'd say, okay, that sounds about right to me. Which means that's nationwide. That means some parts of the country, probably the most previously juiced parts of the country, in the South and the West and California, prices could be down close to double-digit peak to trough.
Mark, always a pleasure getting some of your insights here. Happy holidays to you. Mark Zandi,
Yeah.
Moody's Analytics Chief Economist. We appreciate it.
Thank you. Take care now.